Hello viewers, my name is Ashok Sen Gupta, working as an assistant professor in School of Management Sciences, Lucknow. Today, our topic of discussion is rate of return in case of merger and acquisitions. In previous topics, we discussed about the various concept of merger and with the examples and also acquisitions. We also understand how we can find out the earning per share in case of mergers. So, merger and acquisition is a part of capital investment where one company acquire another company as an investment and invest their capital or join together. Therefore, required rate of return is an important factor to understand by the companies, so they can easily find out what will be the difference between the cost of capital and required rate of return. Therefore, today we will discuss about the aspects of required rate of return in merger and acquisitions. So, what rate of return means in merger and acquisitions? There is a staggering difference between rate of return that a venture capitalist seeks and compared to the ROI of rate of investment with large companies and may seek about the 7% per year as a potential business acquisition. Basically, in the case of mergers or acquisitions, company needs huge amount to invest. Therefore, they are always looking forward to the investment capital or venture capitalist who share their risk and invest their own money with some high rate of interest which company pay to them and get involved in the merger and acquisitions. Let us take example, if a company have need 500 crores, 600 crores, then the company not invest total amount from its own equity or from its own fund reserves. They basically go through the investment bankers or venture capitalist. They offer shares against the investment, they offer shares against the investment to the venture capitalist, and venture capitalist provide them fund for investment. Although some acquirer speaks in term of multiple earnings when they discussed about the concept of pricing on the business, when they discuss about the concept of pricing of the business. Therefore, comes down to the future earnings, and how much of the earnings they available. See, when we talk about the concept of merger and acquisitions, acquirers speak in terms of multiple earning when they discuss pricing. Pricing of a business is the end that comes down to future earnings. How much to those earnings are available to pay back the initial investment. So, when we going to invest in any business, we are looking forward for a good amount of earnings from that business, and this is ROI. and this is ROI. Let us take, if you invest 1 lakh rupees as a capital, at least you need 10,000 per year as annual income. Therefore, your ROI will be 10%. The ROI will be 10%. How company increase their ROI? This is the question. This is a strategy adopted by the companies. Although some acquirer speaks in initial investment, शुरुआत में कितना पैसा देना है, and this amount is huge. But when we invest such amount, in the market, then it is quite sure that we want to get more from that amount. Return on investment or return on equity is a method of measuring the paybacks. Is a method of measuring the paybacks, and it involves forecast of the cash flow of the acquisition versus the initial investment. So, when we do initial investment, our cash go out, and we have to wait for return, but in this case at the time of merger acquisition, if you are starting your business, then you need a huge company. If you started a business, if you start going to invest in a cement industry or power plant, you need 2 to 3 years to complete the whole project, and your project is totally depend on bank loan, borrowing, sometimes delay in borrowing, delay in the project completion. So, if you take that example, then you can need at least 3 years, 2 years, then you generate the initial production for earnings. But now companies looking for merger acquisition because they need ready-made product, ready-made market, tailor-made market, and they acquire that business which is already existing and having its own market, own reputation, own brand. So, this will not hamper the production pattern. Second, duration of investment and duration of getting back payback is very normally it is 0, because the company which merged together, they are already in market, they are working, and merger is a process by the management department and management of the companies, but it will not hamper the product services in the market. Take the example of Vodafone and Idea. They merged, but both were before merging, both companies running separately. There is no issues of services, delay in services, any product hamper. They merged, now they are sharing their businesses, now their profit is earning their profit rate of investment. So, in merger and acquisition, the time duration of rate of investment ROI and initial investment is negligible, because you invest to a company which is already running, it is already in process, and it continue earning the profit, or there is a cash flow, that is why it is nowadays merger and acquisition is so popular. Large companies typically have fair low cost of capital. They can raise money by selling stocks, or they can raise money using debt. Average of these resources is known as weighted average cost of capital. So, in our chapter cost of capital, in our chapter capital structure, we already discussed that debt is a cheaper source of finance, and big companies looking for cheaper source of finance, therefore, they also go for debt and borrow debt, which helps to reduce their overall cost. When companies look for a project, they often compare the rate of return to their internal cost of raising money, their weight of average capital or cost of capital. In capital investment, we saw that when we going to invest in any kind of project, we first compare the rate of earning, we must compare the rate of earning with our cost of capital. So, cost of capital is what is expected by the equities, the rate of return expected by the equity shareholders, that is our cost of capital. And when our cost of capital compare with the project internal rate, and we find that IRR, internal rate of return, greater than, then we accept the project. Because what we invest, return is higher, and what we have to pay against the borrowings again as a dividend to the shareholders is quite lower. When there is a difference, then company accept that project. If the project such as acquisition returns more than WACC, working weighted average cost of capital, is considered to be good deal, When return is more than, these are the keywords, return is more than WACC, weighted average cost of capital, is more than is less than return. Since they can make more money with projects, then its cost will get more, then its cost to get the money. So, it is normally we know all business are for profit, and when businesses are for the profit, they are looking for the better opportunity by acquisition and mergers. The difference in the risk, in fact, trained business appraisers will build up the discount rate, use the valuations. This shall be a start with low risk discount rate, very similar with what large stable company used, and then add risk premium. These are the significant risk premium added just by the fact of company is small. Some high risk techniques areas end up with 50%. So, sometime it is also calculated with the help of discounting and valuation of the company. Discounting is done by the present value method, where we use the formula 1 by 1 plus r power n. Several times we use this formula. This formula is basically belongs to the present value, and we use this formula because we need exact or nearby exact valuation of the company which we are going to acquire. If we predict that we will earn 10,000 yearly, then what will be the actual value after the completion of the years, first year, second year, third year? Because with the increase in inflation rate, what we earn today, its value will decrease, definitely decrease in future. So, what we earn today, it will decrease future. So, if we not calculate or not we consider the discounting period, discounting methods, then it will be quite difficult to the companies to judge the actual value. And finally, if we are not able to judge the actual value of the company with the discounting and premium, risk premium, then the value of the company not able to consider it properly. Second, company face difficulties in future, because if company predict that we earn 1,000 rupees, 10,000 rupees yearly, then what will be the budgeted? It is earning only. If it earned 10,000 rupees yearly, 10,000, 50 lakh, whatever the earning, then company have to predict what will be their profit, and to predict the profit they need to understand and calculate the cost calculations. But we all know with the time period, cost of the companies increased, cost of the companies increased, and finally when we get the actual figures of the earnings, then it will hamper the predicted profit. How it so? Let take example here. I said that 10,000 is annual earning. And overall cost we find at 8,000, 2,000 is profit. But with the valuation of time, if we consider time and put here, may be possible at that time due to the inflation the actual value of 2,000 decreases to 1,800. In this point of time, company get panic. Therefore, to reduce the risk, we try to generate more and more earnings and consider the time value of money. So, at last we can be able to calculate the best profitable amount. Okay. So, we understand that what is RRR, IRR, rate of return in case of merger. IRR concept is same. It is not any, there is no difference in the concept of IRR in case of normal condition or in case of mergers. But in case of IIR, we have to take care of the valuation of companies which are going to merge or which we are going to acquire more thoroughly to avoid the risk or minimize the risk. Whenever any company acquire another company, its value, it have its own values, valuation in terms of financial valuation. When Jet Airways acquired Sahara Airlines, Jet Airways looking forward to do that because first to make its more market capitalization, increase the market share. Second, increase the asset. Now, the Sahara Airlines aircraft also part of the Jet Airways. Third, reduce the competition. But every time mergers is not proper successfully. After acquiring Sahara Airlines, Jet Airways was operating, but due to pandemic period and due to the huge operating cost, Jet Airways face huge losses. This is the result of IIR. This is the result of IRR, where company not able to predict the future, For acquisitions, they borrow lot of amount from the different financial institutions, but due to operating expenses, they are not able to pay. Now, the news is nowadays that they are starting their operations from few days in this year and increasing next year also. So, this is about the IIR. Now, we will talk about demerger. This is the last topic of your subject, financial management and corporate finance. Demerger is a corporate restructuring in which a business is broken into component, either to operate on their own or to be sold or to be liquid as a disinvestors. A demerger allow large companies such as conglomerate to split off its various brands or businesses or business units to invite or prevent an acquisition, acquisitions, to raise capital by selling off component they are no longer part of business, core product line, and to create legal entities in different options. So, demerger is one of the process. A demerger is when a company is split off, जब company टूट जाती है, split off, or more division on operating independent business. It is a company, now it is split off into two parts, it is O, it is A and B, and now A and B are working separately. Demerger may take place on several reasons, including focusing on the company's core operations, splitting of business unit, raising capital. Common type of demerger is split off result a part of company retained equities. So, they are very companies also split to increase to work as independents. It is known as demerger, where a company splits and they independently work. Advantages: focus on core competencies. First advantage, they are focused on core competencies. Second advantage, management accountability, and third is increasing market capitalization. So, there are three main advantage demerger. First, the company focus on the core competencies. If company A having own competency, that is its work its own area, and B is work in other area. Management accountability. During a split off, the manager and management have the accountability to look after their own company. They are separate two companies. Increasing market capitalization. Demerger used to stock market values, create investor have more visibility over the operation of them. The merger, how it is done? The valuation of assets will be related to them, valuation of liability also the result of that. These values are transferred to the balance sheet of the demerger companies. In very few cases, premium to be paid to the demerger companies. So, this is a theoretical concept of what is demerger, and today's lecture we discuss about the various aspects of IAR and merger and acquisitions, and this is the last topic of unit 5th of financial management and corporate. Thank you for all, watching my videos. Okay, thank you.